Today was a wild day of trading. Apple traded up 7%, reaching new all-time highs after its WWDC conference as the market has started to realize that AI competitors will have to compete for its 2.2 billion user installed base, similar to how search engines competed for Safari. And this drove the S&P 500 again to another new all-time closing high and the Nasdaq up 0.88%. But the average stock was down significantly, leading to a huge divergence in market breadth, as today was mostly driven by a handful of very small stocks. So with market breadth deteriorating, how long can the Magnificent Seven hold up the market, and when will everything come crumbling down? That's what we're here to talk about today. We'll be diving into the good, the bad, and the ugly about the Magnificent Seven and my expectations for the rest of 2024. We'll also be diving into earnings, the consumer, as well as JP Morgan's CPI expectations for tomorrow. Are they dovish or are they hawkish? We've got a lot to talk about. Let's roll the tape. Welcome everybody to the daily recap show where we talk about stocks and the financial markets. My name is Chase. If you like this video, please subscribe, hit that notification bell, like this video, and leave a comment for the algorithm. Let's get into it. Now, this is a daily heat map of the S&P 500. And guys, if we just do the eye test, very interesting things you can see. Number one, everywhere looks really red. Look at industrials, real estate, energy. Same here with healthcare, consumer, defensives. There was definitely like major losers, major winners here today. And I think the market is truly just getting a bit jittery ahead of the CPI print, especially with the jobs numbers we got on Friday. You know, I think the market really doesn't want a hot number, because if the market does get a hot number above the 0.4% mark, you can actually see the S&P 500 go down 1.5 to 2.5%. But we're going to talk about the game plan for CPI a little later on in the video. But there were a couple of glaring things that really held this market together. Number one, the big four, right? Have a look at Microsoft, Apple, Google, and Meta. They were all up nearly 1%. Particularly Apple really helped the technology space. Now, there was a bunch of stuff going on with Apple. There was an Affirm deal, and I think that's part of the reason why we saw a bunch of credit services companies fall really bad, particularly this section right here, the tap to cash stuff, the AI innovations, and I think just overall sentiment. WWDC yesterday, I think that's what the market's been waiting for. They've been a bit of a laggard in AI, and the market is starting to see some innovations here and there. So it was a whole bunch of stuff. The innovations yesterday, iOS 18, Apple's tap to cash, and as a result, you know, the market took money out of this, out of financials, into Apple, into tech. But at the same time, the reason why the market also did that is because when everything is red and defensives aren't being bought, the stocks that people buy are generally high quality companies, and the best quality companies are just the Mag 7. You know, Apple, great balance sheet, great revenue, sticky revenue, extremely strong moat. Same with Microsoft, Google, and Meta. So we saw a bit of a flight to quality ahead of the CPI print. We also saw stuff like Amazon was pretty much flat for the day. Nvidia didn't really participate, but semiconductors as a whole didn't. But let's be real, it's been very strong this year, up 149%. The number one performing stock in the S&P 500. Very good movement here in Nvidia. Software actually did pretty all right. Other than that, it was a pretty red day across the board, held up by the big players. We saw XLK and software, the best performing sectors, right? They outperformed the SPY. The SPY returned 0.24%. Then XLC turned 0.9. Then XLC returned 0.19%. And that was really it. Every other stock lost against the S&P 500 today, with some pretty major stocks, stuff like ITB, rate sensitive sectors, metals, financials. And I mean, rates actually moved down today in quite a big way. And we actually saw home construction move down and metals and mining move down. But they were actually up ahead of rates moving higher yesterday. So we're seeing rates up, rate sensitive stocks up at the moment, at least over the last 2 days, and vice versa with it down. Very interesting. I think the market is just positioning and getting ready for tomorrow. And I think the place to be is high quality stocks. And you often find those here in the technology sector, as well as the software sector and XLC, you know, just the mega caps. That's really what these are, with Amazon and Tesla in the discretionary space. But let's hop on the charts and actually look at everything in aggregate. So the S&P 500 up 0.27%, the Nasdaq 100 up 0.71%. That was on the back of Apple, Microsoft, Meta, Google, some of the bigger names, as well as Amazon being flat. But then we look at the broader market, look at the IWM down 0.62%, the RSP down 0.41%. So broader market didn't just have a horrendous day, it had a horrendous day relative to some of the market cap weighted indices right here. Same with mid cap, same with SP 600. So just looking at this, market breadth is terrible. At the same time, S&P 500 puts up a new all-time closing high. It's the second day we did this in a row as market breadth actually declines. That's not something you want to see. And we actually put a new all-time high. We broke above this zone right here in the S&P 500, but we failed to do so in the advanced decline line. So this right here is not quite being confirmed by market breadth as a whole. So that's a major red flag we do have to take into consideration with all of this. Now, everything can change tomorrow. I think the market is just waiting on the macro, and I think a few big stocks are holding up the market while people are probably just, taking to cash, getting a bit defensive ahead of tomorrow's print. No one really knows what's going to happen, especially with interest rate projections, FOMC, CPI, a lot of big data points that's really going to move the market. And sometimes taking a bit of capital off the table, not a bad idea at all. But then we moved down. We actually saw a couple of other glaring things. Rates, the 10-year yield actually was down 1.45% down here in after hours as well. So, in the context of rates actually moving lower, the broad market, the RSP did fall, but it did support some of these tech names. I think they're more sensitive to rates than other stocks. We saw bonds as a whole gain on the back of that. And then let's have a look at commodities. Gold was pretty much flat, up 0.24% here for the day. Silver down 1.63% here for the day. And then the dollar did actually strengthen. And this is part of the reason why stocks actually came under pressure, especially the RSP. Generally speaking, you want a weaker US dollar. Weaker US dollar is generally good for foreign exchange conversions for earnings, and a stronger dollar is always going to weigh on stocks for the most part. And then we also saw oil didn't really do much here today, but it did have a spectacular rally in the last 4 days after that OPEC meeting, up 0.21%. I know it's a red candle, but it did gap up. But let's actually look at the S&P 500. Firstly, let's actually dive into the weekly chart. Let's just close this. We can see that, yeah, we are on an uptrend, higher highs, higher lows, new all-time weekly closing highs. Now, I do know we're only here on Tuesday. The week is still in full effect, but you do have to look at that. Very bullish, and we're at the top end of the week. So when you look at the weekly candle, looks bullish. Just a couple of weeks ago, we were saying things looking grim right here, looking a lot better right now. But, let's dive into the daily. Again, this looks very strong. I mean, when you look at the candles as a whole, we did talk about market breadth. Excluding market breadth, you look at the price action, that looks very bullish. That's a new all-time closing high. That's the second new all-time closing high. And I believe we actually closed above the wick high. So it's not just a new all-time closing high, it's just an all-time new high above all wicks, or equal to all wicks in the S&P 500. That's very bullish. Now, we know the go 5300 is the gamma flip zone, and it's also the put support right now. So, this 5300 area is going to be a very strong level to break. I do think if we get some weakness in CPI tomorrow, we're going to find strong support here at 5300. I don't think it's going to break for the rest of the week. We might wick below it, but I think we'll definitely close at 5300 if we get some really bad news, really hawkish Fed data tomorrow, hawkish interest rate projections, which I don't think is going to be the case. I think the Fed's going to do what they've always done, come out neutral. But I do think we're probably at the top end of the range right here. We did say 5400 was our target into June OPEX. We're now sitting at 5375. So very limited upside here and quite a bit of support on the downside. What does that mean? It probably means we're just going to trend sideways in this range into the June OPEX for the rest of June. I would say that 5300, 5400 is probably your range, and that's probably what the S&P 500 is going to do for the most part. You guys should already be long here. You should already be long here. And right now, we're just buying time. I think if we get to the 5400, there's nothing wrong with just taking a bit of profits off the table, because once we get to the 5400 area, if the call gamma resistance doesn't move up, risk is to the downside. So, still aim for this 5400 target, but I do think that the S&P 500, especially with where we are and with what market breadth is showing us, I think there is a bit of downside risk in the market here tomorrow. So if we do get a bit of downside tomorrow, if we get a bit of volatility tomorrow, don't be surprised. We have come a lot in a really long way, but you have to be vigilant and be aware of what the Fed's going to say tomorrow, especially with Jerome Powell, those interest rate projections. We also get CPI. So that's going to be the market movers tomorrow. And I mean, if you get a cool print and a dovish Fed, we could definitely break above 5400. But I do think that if you look at market technicals and you look at the structure that I follow, once we get to the 5400 area, risk is to the downside, at least to the 5300 area in the interim. All right, guys, I got some really great seasonal stats right here. This is actually really incredible. This is the two strongest multi-market SSL, so seasonal plays for each rolling week from June 8th to July 8th. So you can actually see this is how it works. So this is the week right here. So you can see that this is the 8th of June, 15th of June, then we got the 9th of June to the 16th of June, and then it's a rolling period all the way up until the 8th of July right here. So this is where we are right now. The 11th of the 6th, so 11th of June to 18th of June, 12th of June to 19th of June, and 13th of June to 20th of June. And you can actually see that the best play in this period actually is short wheat, short wheat, short wheat, all the way up until the 15th and the 16th year, where you then want to go short silver, short silver. Now the returns on these are generally very, very good. You could see negative 0.71% for the rolling week, 0.2, 0.54, 0.56, 0.57. These are all declines in the price of wheat, so they should be very, very good plays nonetheless. Now if we actually go all the way down here, you can see from June 24th up until the 1st of July, the best trade is actually long S&P 500. Average return in that week 0.055%, and that actually continues all the way up until, or from the 29th of June up until the 6th of July, where long S&P 500 returns 0.55, 0.73%, 0.84%, 0.83%, 0.55%, and 0.48%. So very, very positive towards the end of June here into early July period. Very, very interesting stuff. So, but if you guys do want to pause this video, you can go ahead, have a look at these very interesting trades if you are looking to just generate some short-term alpha. Now, looking at earnings in the week, guys, today we're going to tackle Oracle, but there's not much here on the week. We do have Broadcom tomorrow. That's a big one. And then we have Adobe. So some notable names on each day, but not dense, not packed, not market cap heavy weeks as it was earlier in the month of May and at the start of this month. But let's talk about Oracle. Now, Oracle earnings, bit of a dumpster fire. You can actually see it was a double miss. So expectations for earnings per share, 1.65. What did they report? 1.63. On sales of 14.3 billion, the expectation was 14.55 billion. However, the stock was up 9% here in after hours on a couple of things. Number one, cloud revenue accelerated, and that's the major thing. Cloud revenue is up 20%, infrastructure revenue up 42%, and application revenue up 10%. Actually, these beat the street's expectations. There was just a bit of expense management here on Oracle's side that led to the EPS being down and a couple of orders being pushed back a couple of quarters. That's exactly why the revenue missed. However, they also did announce a partnership here with OpenAI and Microsoft, a cloud partnership deal. Pretty much OpenAI, ChatGPT is going to be using a lot of Oracle's cloud servers. I think the demand is just a bit too high. I think Microsoft's cloud segment, Azure, just needs a bit of help, and they're using Oracle to offload some of the stress with regards to AI. So very, very good deal for Oracle. I think this is going to have tangible effects on revenue in the future. And very much like Tesla's earnings, where we had a double miss, the market looks to guidance. That's why these shouldn't be called earnings reports. They should be guidance reports. And that's why the stock is up 9.32% here in after hours. So Q1 earnings season is really coming to a close. I mean, we had Oracle today, we have Broadcom tomorrow, Adobe on Thursday. The next week, I think the only big name we have is Nike. And then after that, earnings season for Q1 is done. Then we just have a week break. And then in the first week of July, Q2 earnings season begins. And these are the expectations right here. S&P 500 earnings growth is right now at 9.2%. That's the expectation. And 4.7% here on the revenue side. Now, these are the estimates as at the 4th of the 30th, 4.6% on the revenue side and 9% here on the earnings side. So we've actually seen very, very mild up revisions to where we are right now. I believe these estimates are as of just a couple of days ago. Very mild up revisions, very close to double-digit growth here on the earnings side, with the best sectors being stuff like healthcare, energy looking to grow 16%. We also see tech here up 16%, and then comm services 18.4% earnings growth. And then on the revenue side, same companies, you know, it's tech, comm services, energy, and healthcare producing the most revenue. And that seems to also be the trend with revisions. You can actually see here that sector level change in Q2 EPS. Revisions to the upside have been energy, comm services, financial, discretionary, and information technology. And from March 31st to May 30th, S&P 500 has been revised up 0.3% here. So, you know, the stocks, the biggest sectors, the biggest stocks have seen the biggest up revisions, and that's why the market as a whole has actually seen upward revisions. Now, revisions to the downside, we've seen stuff like materials, real estate, utilities, but then really these three matter. You know, healthcare, staples, and industrials have all been revised down 4.3%, 2%, and 1.1%. So these aren't necessarily big sectors. Industrials is sort of like a mid-sized sector. Healthcare is a pretty big sector, but staples is largely a very small sector. In fact, the entire market cap of the consumer staple sector is actually the market cap of Nvidia. So if you guys are looking to get into certain sectors for this earnings season, I would definitely either look at, you know, the top of the range here, stuff like comm services, energy with these up revisions. Or maybe if you're looking for turnaround plays, you can look at stuff like industrials or healthcare. Personally, I would stay out of consumer staples. That's what I would look at. Look at the top end right here or the bottom end for earnings plays. Maybe these guys beat and we get a lift, or if you just want to play the momentum play. Normally the second stocks get revised to the upside. We generally do see momentum follow suit. Now, breaking down earnings further, having a look at the second quarter right here, we can actually see that 24% growth is expected in the Mag 7. And this figure right here actually includes Tesla, which is exhibiting no growth on the revenue side and earnings side, maybe even a little bit of negative growth. And then the broader market, excluding the Mag 7, so the 493 is expected to actually grow 6%. So we should actually see an inflection quarter here in the second quarter. And then we actually see continued robust growth for the market for the rest of the year. 14% for the Mag 7, 6% again for the 493, and then 15% for the Mag 7 here in the fourth quarter, and then 18% for the broader market. So, and the broader market should outpace the Magnificent 7 earnings after what was an incredible run here for the Magnificent 7 names. And just because this says 15% growth and this says 18% doesn't mean the Mag 7 can't outperform on a price performance basis. This is still 15% growth relative to the fourth quarter in 2024, which was actually a very good quarter nonetheless. So let's talk about the economy. Now, we got this note here from BofA. It covers everything from the economy, CPI. So they say trading catalysts, no landing, back in debate. That's not bearish at all. So economics, CPI likely to change the view for FOMC. The strong jobs report reduced concerns about a broader economic slowdown. This week, however, the focus will shift to inflation and the FOMC meeting. That's tomorrow. We expect the CPI report not to be a game changer for the Fed. Core CPI should be little change from April as services inflation remains sticky. The Fed, meanwhile, is likely to guide towards patience. So they're going to say the exact same thing.
My colleagues and I remain squarely focused on our dual mandate to promote maximum employment and stable prices for the American people. The economy has made good progress toward our dual mandate objective. Inflation has eased from its highs without a significant increase in unemployment. That's very good news. But inflation is still too high. Ongoing progress in bringing it down is not assured, and the path forward is uncertain.
Looking at equities, no landing, back in debate. That's not bearish. Stronger growth is better as long as inflation remains in check. And we expect a strong second half acceleration in EPS. The worst case of NFP and hot CPI has also been avoided, at least for now. And despite some concerns, recent macro weakness suggests that growth is simply normalizing. If macro starts to improve, equity should be able to withstand higher levels of inflation. If NFP was just a head fake and macro slows, inflation would have come down to support stocks, and it likely will. If CPI cools despite hot NFP, it's risk on. So if we get a cooler CPI tomorrow, that is your risk on signal, and we'll probably go 4,500 and above. If CPI comes in line, it's going to be business as usual. Derivatives, SPY call spreads for jobs up plus soft CPI tally. CPI and the FOMC fall on the same day for the first time since June 20. This has happened only 7 times since 2014, and with the S&P 500 moving just 63 basis points on average, though most were in 2017 and 2019 when inflation and equity vol were low. Given the equity resilience to the NFP print, SPX down 0.1%, low likelihood of Powell ruling out 2 cuts in 2024, and the potential for NFP up, CPI down, we find value in positioning for a rally with options, e.g. SPY 21 545 to 550 call spread cost 76 cents, 6x max payout, risk limited to premium paid. Pretty much what BofA is saying. If CPI comes in cool, that's good, equities rally. If CPI comes in line, that's good, equities rally, business as usual. If CPI comes in hot, that's gonna be an issue. However, if the macro starts to improve, equities should be able to withstand higher levels of inflation. As long as the macro holds, as long as growth holds, as long as jobs remain strong, equities should be able to handle high inflation and higher for longer. At least that's what BofA says. So very, very interesting dynamic right here. And again, risk right now for equities to the upside. Looking at BofA's consumer finance dashboard, this is very, very interesting. Now, here they say key metrics for employment, income, spending, and lending are mixed, but we're actually going to go through them, right? So the employment rate right now is sitting at 4%. A bit high, but not historically high. And generally speaking, after everything we've had with COVID and where we are in the normalization, 4%, not a high number at all. So we're not going to look at initial jobless claims. We're not going to look at continuing claims because we know what the NFP numbers are. We got it last week, 272. So this number right here is a bit outdated. That's the actual NFP number. Jobs are looking very, very strong. The labor market looking very, very healthy, all things considered. Then we dive into subcomponents of the labor market, specifically income, right? Average hourly earnings actually actually increased on a month-over-month basis, up 10 basis points, so it's up 0.1%, right? But if you actually look at it on a year-over-year change, wage inflation actually decelerating. That is good for the inflation picture. Personal income, however, is actually increasing while wage inflation, average hourly earnings, is actually decreasing. What does that mean? It means that real incomes are increasing. That means inflation is decelerating, allowing for higher disposable personal incomes. And then we got new bankruptcy cases. So it actually has 12.9% increase year-over-year change, but I'm going to put the chart up. New bankruptcy filings are still at historic lows. So this is not anything to be concerned. So when we look at the unemployment rate, non-farms very healthy. When we look at income overall, very, very healthy. Then we look at spending and lending, adjusted retail and food service sales up 300 basis points, bullish. Consumer confidence up 17.1% in the last year, bullish, but down 10.5% in the last month. And then revolving credit balances up 6.7%, but 0% in the last month over month. Again, this right here, revolving credit balances, as well as consumer confidence, is actually just normalization to where we were. And then we're not going to look at rates. So even though it says here these key metrics are mixed, to me, I think the consumer finance dashboard looks very, very strong, particularly if we adjust these non-farms right here. And then you dive into the details as to what these mean on an individual basis, specifically personal income and average hourly earnings. So the consumer is looking very, very strong. And then when you actually compare disposable income, employee compensation against PCE inflation here at 2.6%, you can actually see that employee compensation and disposable income is outpacing PCE inflation here on a 1-year annualized, 6 months, as well as 3-month annualized basis. And then if we actually look at other measures of the consumer, stuff like number of flights per quarter, people are flying is back. And normally, sure, this might be for business purposes, it might be for tourism purposes. Matter of fact is flying is back, and it doesn't even show here, but this right here is equal to some quarters we saw in 2019 and 2018, 2019, around that period. That was peak air travel globally. So we're getting back to those 2019 levels. Another measure for the consumer is US rail traffic. Look at total intermodal units this week versus 2023, up 10%. Look at it year to date, up 8.7%. And again, total traffic, which is actually just a measure for GDP, 2.4%. And then year to date, 1.9%. So different metrics to look at, and know all these different metrics pretty much tell us that the consumer is very, very healthy. And especially with inflation coming down, this is going to be supportive for equities. People have jobs, people have money, people are spending money, and they're spending more money than last year. And this is overall good for the economy, good for growth. And at the same time, inflation is coming down. There's a whole lot of disinflation happening. We're in a very good environment. So don't let any of the bears tell you different to what the data shows. Data tomorrow now, we do have the CPI. So what are the expectations? So you can actually see here that the consumer price index, the year-over-year figure, the headline, we're expecting 3.4%. And then a month-over-month, the headline figure 0.1%. Then the core variance year-over-year 3.5%, and then 0.3% month-over-month. We also have the monthly budget statement tomorrow, the FOMC rate decision, as well as interest rate projections for this year, 2025, 26, and the long run interest rate projections. Then the day after that, we have PPI, but we'll discuss that in tomorrow's video. Also, for those of you that don't know, we look at GDP now quite often, but what we also have is an inflation now. You can actually have a look at CPI and PCE. This is the nowcast version. You can see here in May, right now, CPI is printing at 0.08%. and the core version at 0.3%. So this is partially where BofA actually get their projections from. And then PCE this month at 0.1%, 0.23%. And you can see that June is tracking at 0.14, 0.29% CPI, core CPI, and then PCE 0.13, 0.22. So June tracking a little bit higher on the PCE side, but a little bit lower here on the core side, but very, very mixed across the board. This is when it was last updated, but just something that if you guys want to go track CPI, you can just go Google CPI now, and then you can just have a look at this chart and see what we're tracking for CPI, PCE, also GDP now for the months of May, June, and I think there's other months there as well. Now, JP Morgan have laid out tomorrow's game plan here for CPI. So they say if the CPI reading comes in below 0.2, probability of that is 2.5%. This should be the market's reaction. If CPI comes in below 0.2, below 0.2, 0.25, 0.25, 2.3, the probability of this is anywhere from 2.5 to 25%. You can actually see gains in the S&P 500. So a cool number would represent gains. Anything between 0.3 and 0.4, you're looking at losses to a gain of 0.5 to 0.75%. Anything above 0.35%, you're looking at down 1% for the S&P 500, and anything above 0.4, the probability of that is 5%, down 1.5 to 2.5%. The game plan is as as it's always been. If the number is hot, S&P 500 is going to go down. If the number is cool, we're going to move higher here. So let's dive into gamma. Now, very interesting things are happening. Number one, look at where the gamma flip zone has actually moved to, 5,300. It was at 5,200 2 days ago. Then yesterday at 5,100. Now it's at 5,300. The exact same place where the gamma flip zone is right now. So this is the put support. It's moved to the 5,300 area. Very, very interesting. So listen, this 5,300 area is going to be very, very strong support. If the market does pull down to this 5,300 area, I think, let's say we get a CPI over reaction tomorrow, 5,300 is going to offer very, very big support. We still want to aim for the 5,400 as our ultimate target, and we can actually see here that we are having the 5,450 and 5,500 strikes getting built out quite significantly, especially this 5,500 strike right here. These act as magnets. We know they do. So buy dips, sell rips at the 5,300 area. Look for these higher strikes, particularly the 5,400 strike. But if you've made it up until here, thank you so much for watching. If you like this video, please subscribe, hit that notification bell, like this video, and leave a comment for the algorithm. Cheers.